poor collections on your financial reports, if the association hasn't saved money in their reserve account and they need to do a capital improvement, say they've got a leaky roof and they have to replace the roof, well, they don't have the money to do anything about it, but they got to go out and get a loan. So if you go to a bank and you have over 15% delinquency rate, you're at risk of not being approved for a loan that you would use to do the work.
HOA Insights is brought to you by 5 companies that care about board members: Association Insights and Marketplace, Association Reserves, Community Financials, Kevin Davis Insurance Services, and the Inspectors of Election. You'll find links to their website and social media in the show notes.
Welcome back to HOA Insights, Common Sense for Common Areas. I'm Robert Nordlund, and I'm here today for episode number 148 with Russell Munns of Community Financials, one of our podcast sponsors. Community Financials provides condo and HOA accounting and other remote services, so he's our go-to guy for financial tips for our HOA Insights program here. Today's episode is called How to Save Money at Your HOA. Now, to be clear, Russell and I don't have a magic wand, and we don't believe you save money by simply not spending. Owning and maintaining real estate is expensive. So today's program will be Russell explaining from his vast experience how to take good care of your association's physical and financial well-being without making mistakes that end up costing you extra money. Last week's episode number 147 was another of our popular Board Hero episodes, this time with Tim Long from New Mexico. He shared a moving story about how they built community at their association because of their budget process. Now, you heard that right. Their budget process was tense and was a challenge, but it was not divisive. So listen to that episode to find out what they did differently to actually draw owners together through their budget process and make it a community building opportunity. So if you missed that episode or any other prior episode, take a moment after today's program to listen from our podcast website, hoainsights.org, or watch from our YouTube channel. But better yet, subscribe from any of the major podcast platforms so you don't miss any future episodes. Increasing our subscriber base increases the podcast's position in search results, so becoming a subscriber helps others find this free resource so they can be better equipped to lead their association. Well, those of you watching on YouTube can see the HOA Insights mug that I have here that I got from our merch store, which you can browse through from our hoainsights.org website or the link in our show notes. You'll find we have some great free stuff there like board member Zoom backgrounds and some specialty items for sale like mugs. So go to the merch store, see what we have for sale, and at least download the free Zoom background while you're there. Well, we enjoy hearing from you, responding to the issues you're facing at your association. So if you have a hot topic, a crazy story, or a question you'd like us to address, you can contact us at 805-203-3130 or email us at podcast@hoainsights.org. Now, this episode was inspired by Jeff from Lake Tahoe, who wrote in, "Money is always tight at our association. What can we do to limit our assessment increases?" Well, that's a hard one. Jeff, I don't think we have the power to stop inflation, but indeed it's questions like this that made me think that we need Russell back on the program. So, Russell, I know you came with a list. What did you want to talk about today to help our audience save money at their association?
Sure. Well, thanks, Robert. I want to first say that it is hard right now being an owner of a condo or home in an HOA. Owners are getting clobbered with increased costs, whether it's the property taxes have gone up because house values have gone up over the last 5-6 years, and HOA fees have also gone up. And at the same time, their asset value is going down, in some cases, 20 to 30% in some markets.
Actual home values.
Home value.
Okay.
So cost of living's going up, home value is going down, and the home is the biggest asset for a lot of people. Similarly, if you're owning, a different kind of asset like stocks, the general market can impact the price of the stock, but the value of the stock price can also be affected if the leadership of that company makes poor choices and the stock price goes down. So what I want to emphasize is board members are the leaders of their corporation and the HOA and the condo community. This episode is to help them with part of what is clobbering the homeowners, and the board members are homeowners too. So they're under extreme budgetary pressure. Insurance costs, utilities, maintenance, and costs have risen significantly on all fronts. So what many don't realize is that this isn't just the treasurer's problem.
Yeah.
This is something that the entire board needs to be, working on.
And can we say the entire industry? Because it's not just your association. It's every association.
This is going on in all the states, all the different neighborhoods, and some, when a home buyer looks at where they're going to buy a house in a condo unit or a homeowner association, they're looking at what the monthly cost is. And that monthly cost, the common charges, are dictated by the budget of the HOA and the community. So what we really want to dig into is what type of smart choices can we make to impact part of that home ownership cost, which has a direct impact on the marketability of your home. If I'm looking at two different properties, one across the street from each other, they're both pretty similar, right?
Same school district, same access to grocery stores.
Double the HOA fee, right? I'm probably going to go to the other place across the street that has half of the cost. And those home prices might be a little bit more expensive, but my monthly carrying cost is going to be less.
Okay. Is that always a good thing?
It depends on your budget and where you want to live, right? But if you have similar products and one costs more than the other, and they're approximately the same kind of amenities, quality, value, you're going to choose the one that fits their budget. And they're going to go to the one that is, even if they pay a little bit more on the home price, because the mortgage is locked in, the HOA fee is lower, they're going to have a lower cost of ownership.
Yeah, just carrying it each month.
Exactly.
Okay. So
we got to look at ways that the board, being the leaders of their corporation, can make smart choices that will reduce the need to increase the homeowner association or the condo dues frequently, or reduce the impact of needing to make special assessments either on an ongoing basis or something that's like the norm at that community, because people don't want special assessments. And for decades, people don't want increasing dues or membership fees, although that is likely, going to happen because of inflation. But there are other things that are within the control that we're going to talk about today that can reduce those costs, or ways, techniques, and tools to look at as board leaders to help to reduce that pressure of those increases.
Got it. Okay. So you've got a list. Let's start touching on the list.
If you are not collecting dues, it has the same impact as overspending. So you need to make sure, because you have a fixed income based on the number of units in your community, homes of units, and what the common charges are, right?
Right. You
have a fixed income coming in. And then if you have people that aren't paying into that system, that impacts, instead of having 100% of your budget, now you've got 95 or 90% or 80% of your budget that you had to spend. So that's the same thing as having 20% more cost in that last case.
Right.
So we have to look at how we can improve collections and taking a proactive management approach to collections.
Yeah, because if you're only collecting 90%, then you're inclined to increase your assessments 10% to be able to pay all your bills.
Yeah, and because the rest of the people have to carry those that aren't paying.
Exactly.
So,
okay.
There's many governing documents have late fees. A lot of communities don't charge them because they're difficult to administer, or they don't have a system to administer it. So one, it's a deterrent, so let's use it. Two, see if that late fee, if it was in a governing document from the 1980s, it might say $15, and that's not much of a deterrent if someone's not paying. So make it, see if you're making changes that it's a real deterrent. Then give people lots of different ways to pay. Let them pay by check. Let them pay by, credit card if they need to. Let them pay by, online if they want to. So lots of different ways for people to make payments.
Or Apple Pay?
Yeah, yeah. Well, I don't know about that because I don't think that works with a lot of the systems in the industry. But
But
you
give them
need to
options.
have a systematic one process. And this one of the reports you're going to review is your age delinquency report, so you can see, okay, we've got a collection policy. The collection policy lays out at day when somebody's 30 days past due, this is what we do. If somebody's 60 days past due, this is what we do. If somebody's 90 days past due, this is what we do. And the importance here is in about half of the states, there have a statute that's called a super lien, which allows the HOA to gain the HOA money that's due to the association to gain priority over other lien holders.
Okay.
But it's only for 6 or 12 months or unpaid assessments. So what that means is if you get after the association, you go to a foreclosure to get somebody to pay. If there's not enough equity in the home, the association gets 6 to 12 months of its unpaid assessments. And then after that, the mortgage gets paid. And then the HOA goes behind the mortgage. And if there's no money left, then all of those other payments that are past due from months 6 or 12 beyond, it's
That go away.
uncollectible. And so the association doesn't get it. So you need to have a focus that you don't risk losing that money. And the other thing I want to say is one last thing I want to say.
Okay, you
A
go.
lot of states have a shelf life for bad debts. And I've had communities come to us and they have somebody that hasn't paid in years. There's a shelf life in most states where debts commonly that are either 3 to 6 years old, where the debt becomes legally uncollectible in court. So, you can't carry these deadbeat payers for a long time because that gets uncollectible as well. And so those are just two items I wanted to point out that you got to make sure you handle these things seriously.
Got it. So make sure that if they miss their first one, if they're a few days late, try to not let them become 30 days late. Try to stop them from becoming 60 days late and have your pressure points and enforce those.
And, you
Okay.
have a notification system that's nice that says, hey, you missed paying your dues, please pay, or whatever, because somebody may have forgotten it. But you just have to have a way of systemizing. And then the next thing I want to say is poor collections on your financial reports. If the association hasn't saved money in their reserve account and they need to do a capital improvement, say they've got a leaky roof and they have to replace the roof, well, they don't have the money to do anything about it, but they got to go out and get a loan. So if you go to a bank and you have over 15% delinquency rate, you're at risk of not being approved for a loan that you would use to do the work. But over 10% puts you at risk. And this is also especially tough for smaller communities where just 1 or 2 delinquencies can get you to that threshold.
Yeah. Well, what I'm hearing is that you need to have a system. And for an association with a management company and an attorney on call, I trust that they have a system. With community financials, as long as you're on the program, I want to ask you, is that one of the things that you can systemize for the little self-managed associations out there?
Absolutely. Absolutely.
Good. I don't think I ever asked you that question before, so it's good to know.
Nobody likes collecting money from their neighbors, being the person that says, hey, you owe the association $300. When are you going to pay it, right? It's not something you want to bring up at a neighborhood block party. But it's, so let somebody else help with that.
Be the bad guy. Yeah. Okay, good. I like that. What else?
The next thing is you need to get financial reports on a monthly basis so that the board knows what's going on with its financial picture. It's so many times where I talk to community boards and they're not getting financial reports on a monthly basis. Maybe they get it quarterly, or maybe they get it sporadically because somebody wasn't preparing them on time. But in any event, this is already old data. So you want to make sure, like we talked about before, that you see what's happening at the community so you can react to it. And one of those key, we already talked about the delinquency report, but another key financial report to look at is the comparative income and expense statement. Now, what that is it has all of your income, and all of your expenses listed out on a report. You're going to see for the month, the prior month, how much income and expenses you had. Then it's going to have a column next to it that said, okay, this is what we had for a budget for that period. And then it's going to show you the difference. Also, on the same report, it's going to show you where you are year to date. So year to date, how much have we collected in income? Year to date, how much have we had expenses? And how are we doing on budget? So when you look at this, you can see, oh, geez, we're like double what we budgeted for this. And why is that? And that's what you use that report for, is to ask that why is that question. You may have a good reason, but you may not have a good reason.
Yeah. Well, if you're on the East Coast and your snow removal is high, well, number one, it's wintertime. So this is when you expect to get a year's worth of expenses. And we've had a lot of snow lately. And so, yeah, if there's a good reason, there's a good reason. But if all of a sudden your water bill is high or something else is high or your collections are low, then that's, again, one of those things you want to jump on soon.
Exactly.
Okay.
Especially there's a lot of states that they didn't expect a lot of snow, or maybe you have more snow than you had the previous year and you're using the previous year to make your budget. So you're going to be over budget in this. So, one of the things, and I used to run a management company for 16 years in Connecticut. So if they had unusual snow, a homeowner doesn't want to get a special assessment bill for snow removal in August. Right. So if you got to do a special assessment to cover the shortfall, do it while people still remember that there was a snowstorm.
Do it while you remember the pain. Yeah.
Exactly right. And, that's a way of covering the gap in what was projected in the budget. But some real examples of early detection to save significant money is water leaks. You wouldn't believe how many times there was a truck that came to the association. They did something where they were tree trimming or, some other landscaping. They backed their truck over a pipe. It was the water pipe. No one can see that there's any leak, but the water bill quadruples. After a couple of months, there's like $3,000 of a water bill that you're like, whoa, what's going on here?
Yeah.
If you're looking at the financial reports, you're going to see that something's going on. And then you can do some investigation. Another thing is maintenance. If your maintenance, is one of the things that is, and we'll talk about this later, but I got another example, but maintenance is something that can go poorly quickly. You're spending a lot of money on water leaks, for example.
Yep.
But I'll get into this in the next thing is I'll give an example of that. But those are things that you want to look at in the financial reports to then ask the questions, why is this over budget? And then do a little investigative research and see if there's a way that you can get back on budget, fix the problem.
Try to keep things tight. Don't let it get out of hand.
I will say the next one is fix it. This kind of comes into the same thing I was talking about. Fix it right the first time. And I have seen this over and over again with roof leaks, where we're going to patch it for $2,000 or $3,000, and inevitably the patch doesn't work. And what you end up having is water infiltration that ruins drywall. Paint has to be remediated for mold. It ruins carpets. It ruins cabinetry. You've got multiple parts of the house that needs to be repaired. Now, this is more in townhomes and in condos in this particular example. But if you were to, and I have seen in my years of doing, working in this industry, communities that this was their mode. They would just patch, and then they would have this huge maintenance line item because they were constantly fixing drywall and repainting homeowners' units and working with like a water remediation company to go through this. And they had to do this for 8 units a year. I mean, it's like crazy. And to the brain damage of having to manage this over many different seasons with many different homeowners who are really upset. It's a problem, but it's indicative of a board that's not, this is, we're always used to, this is just normal for us. It's not looking at the big picture of, okay, we need to fix the roof and we won't have to deal with these problems anymore. Our budget's going to go down.
Yeah, that's not a good normal. I'm fidgeting here because I hate the $500 or $1,000 roof leak that is a patch on a patch and it leaks, and it ends up being a $10,000 or a $20,000 interior repair type problem.
And then you've got like, you got to pay the your deductible for the insurance company, right? And then your insurance cost goes up. It's just a snowball effect. But this is like indicative of poor management and leadership by a board, and you don't want to fall into that trap.
Russell, I'm looking at the time here. We need to take a quick break. I want to follow up on that because there's pressure when a board feels we don't have enough money to replace the roof. And that's a reserve problem, but we'll get to that after our break. It's time to take a break now, hear from one of our generous sponsors, after which we'll be back with more common sense for common areas, and today specifically how to save money at your association.
Are you part of a homeowners association or condominium board? Making the right financial decisions for your community's future is crucial. At Association Reserves, we're proud to serve communities nationwide, specializing in reserve studies tailored to your community's unique needs. Our expert team helps you accurately assess your property's assets, forecast future expenses, and develop a solid funding plan. Whether you're a small HOA or a large condominium association, we've got you covered. Visit reservestudy.com to learn more and get a proposal for your association.
And we're back. Well, before the break, I was starting to get all fidgety because I feel the pain, I feel the pressure of poor decisions. And some of those poor decisions come from the pressure that, we don't have the money to do it right. So Russell, is that what we're talking about with the reserve pressure?
It is. And there's a couple of examples I want to say is, just like I talked about before with the value of condo prices, we'll just use condos right now, but it also happens at HOAs. In Florida, they've been working on a structural integrity reserve study after a collapse of a building. So now there is more pressure to save money for reserves. And a lot of communities were underfunded on reserves and now have to make up the shortfall. So that is providing upward pressure on the money that they have to put up that they weren't anticipating or they weren't paying before. Florida's not alone in this, though. As you know, there's a lot of other states that are also having more, and after that event, are having more and more, regulations on reserves. And so, the reserve is something that needs to, be funded because you need to have that money set aside to make these replacements happen. And just like we were talking about before, you're going shopping for a new home. One community across the street has reserves and they've got $1 million in the bank. Another similar property, same age, has $50,000 in the bank.
Right. Yep.
It feels safer for me as a buyer to go to the one with $1 million so I don't have to pony up the reserves. And I had a friend who recently bought a condo. It was negotiated at the sale that the seller had to pay for the upcoming structural, reserve fund.
Right.
And that was how they worked it out. But, it's going to impact the value one way or the other. So let's take care of it now. And so I'll talk with you. What are you seeing behind, setting aside money for this so that people don't see it as an expense, but they're seeing it as a valuable thing that they can't escape?
Yeah. Well, first off, it's a perception issue. Deterioration is like the sand through an hourglass. It's not like a future roof project that you're trying to avoid or a future boiler project. Every day, due to Mother Nature and Father Time, they're the bad guys. A board doesn't have any choice about the expenses. The roof is going to fail, the boiler's going to fail, the asphalt's going to fail. The board has no choice in that. All you can do is offset the ongoing deterioration with your reserve funding so that you have the cash when the item fails. All you're doing with funding reserves is preventing your own special assessment. You're not creating charity for the future. You're not paying someone else's bill. You're simply offsetting your own deterioration bill that every month the roof gets a little bit older, the asphalt gets a little bit older, that kind of thing. And when we look across the entire market and across the entire industry, that reserve bill is very often about 25% of an association's total budget. So it's a big number, but there's, again, no choice about that. if you don't pay it with your ongoing budgeted reserve transfers, you'll get hit with a special assessment. It's just that simple. So don't feel like you're the bad guy as the board saying we need to raise our reserve funding. The bad guy is Mother Nature and Father Time. Point to them to say, we're just trying to offset the deterioration that's happening now. And that will mean that whoever is sitting as a homeowner in the future will have enough money to pay that roof bill because everyone paid their little fair share over time. So we see just a lot of perception issue that they don't understand.
Get ahead of it. Get ahead of it,
Yeah.
and budget for it, and it'll just
Yeah.
be part of the process.
Exactly. Okay, good.
Another one that comes up as has been the villain in this budget ruining kind of
Scenario that we have. Yeah.
Insurance. So insurance has been the bugaboo. So insurance prices, I can't tell you the number of communities that needed to do a special assessment because their insurance went from, say, 50,000 to 350,000. Crazy. Or something like that, right? So it may have happened on a smaller scale at your community if it's smaller, but it could go 2 times, 3 times, 4 times the amount that it was the previous year. And why is that? It's not just because there were fires in California and hurricanes in Florida, although that does add
That's a
to
factor.
it. But on an annual basis, the insurance company is going to send out a representative to look at the community. And in their renewal, they're going to send out a list of requirements or recommendations. They call them recommendations. It could be a substantial list of things that they want done that will reduce the risk of an insurance claim, right?
Yep.
And if the community just takes them as, okay, they're recommendations and does nothing about it, they are leaving, many of the underwriters are going to cancel them. And when they get canceled, they go to something called the surplus lines. And surplus lines is when your insurance rates go through that, giant jump that we just talked about. Now, what the community should do is somebody needs to be tuned up where they are looking for those recommendations and they knock them out in 60 days as best that they can and communicate with their insurance agent that they have a plan to deal with it so that they will get renewed and they will keep their insurance. Maybe their insurance stays about the same. Maybe their insurance goes up by a little bit of inflation. Maybe their insurance goes down. That's also possible.
Yeah.
But they have to do these recommendations, and they're not just recommendations. They need to do it so they don't risk getting canceled. And then if they're canceled, there's fewer and fewer options for this segment of housing stock. And so that they risk going to the excess lines.
Yeah, Russell, I got to add in that board members do have agency in this. They can participate. And just like you say, don't take that recommendation as just, nice to do. There's 2 associations. I live in Southern California, 2 associations that we know of, just a couple miles from my office where I'm at right now. One has stable insurance premium costs. The other one had to pass a big, I think it was a $5,000 per unit special assessment because of fire exposure. And the difference is one spent about 10 grand clearing the hillside at the perimeter of their property, and the other didn't. So one took the recommendation, one didn't. One spent 10 grand to clear the hillside, the other didn't. Boy, the second association spent way more than 10 grand in $5,000 per unit special assessments. Gee, just 2 units worth would have paid for that tree trimming. It was just crazy. You got to do that.
And there's lots of things like that. There are, if you have hot water heaters and you're a multi-floor community, you need to have shutoff valves on the hot water heater. So if it leaks or breaks, that doesn't keep flooding for hours and hours, and there's a drip pan underneath it. There's all these recommendations to do smart things.
There's alarms for that now. Yeah.
Exactly. So you have to get ahead of this insurance. The other thing that I see is if you're updating, communities have tried this when they're updating their governing documents, is that if there's something that was due to the negligence of an owner, that the deductible is then passed on to that unit owner. So that's something they can talk about with their attorney. But then it's not the association's cost of covering that insurance deductible. It would be the offending owner that caused the issue. So
I like
those
that.
are things, another thing to take a look at, because those deductibles can be, $10,000, $20,000.
Yeah. Okay. Last couple things.
Get what you pay for from a service provider. So I have, this could be vendors give you a flat price. They tell you they're going to do these things and then they don't do them. And so they're cutting corners. And it's like my son looked at, like, we got this big wrapper for a candy bar. And when you opened up the wrapper, inside was this teeny little candy bar. And he felt gypped. So the same thing happens. I get talked about, and I'll use one example. The boards tell me we're paying this big price for management, and we're doing all the work ourselves, and we're getting some accounting support, but we're calling the vendors because the manager won't get back to us. So the managers have a tough job, right? And they may have high turnover of staff. The manager might not be trained or experienced. They might not do the things in the contract, and they may be handling too many customers without enough staff. That's the whole, student teacher ratio. Like, how many are you running? So oftentimes the board volunteers say, I'm doing the job of the manager. I call the manager doesn't call me back. I try and find out what's going on with the vendor. I call the manager. I don't hear back. So then I have to call the vendor myself. I asked for a bid on something. They didn't get back to me. I have to do that. I haven't seen them around the property. So I'm walking around and I'm telling the vendor what they have to do. This can happen with any vendor. I'm just using that as an example. But this happens with landscapers, right? It can happen with any vendor. Somebody has to be supervising what's going on so that you make sure that, corners aren't being cut. So you do have options. I just want to say this. There's the perception that it's just working with a property management company, what's quote unquote called full service management. And then there's also the board does everything 100% themselves and it's self-managed. But there is a middle option where the board can do the board does like a third, let's just call it a third of what the manager did. They're calling vendors, they're getting bids, they're holding their own meetings, the secretary's taking minutes. And then they work with a service provider that handles, let's say, accounting and let's say resale and lender questionnaires and other compliance issues, and provides software to make it easier for the board to do. So I would just say, So there's cost comparison. You could save money because you're not doing the job of the manager and paying the manager full price. Or, similarly, go out to bid if you find like your landscaper's not doing what you told them to do. A lot of times I talk with the communities, landscaper is the most expensive item on their budget. Well, put that one out to bid if you're not 100% satisfied with them. If you wouldn't rate them a 9 or a 10, go out to bid next season and get, three competing bids and see how they're doing and see if somebody, will handle it.
Yeah. Okay.
At a better value.
One last one to finish off with.
There's fraud prevention through checks and balances. So this is one I don't want to talk about. It shouldn't happen that often, but it does happen. And unfortunately, so if somebody, like one board member has a checkbook and they pay bills, maybe I've done 25 fraud case studies. And sometimes somebody comes on hard times and then they write personal checks. There's other times when it's a conflict of interest and they pay bills to a family member's business, right? And maybe it wasn't vetted. Maybe they were cutting corners. Maybe the quality wasn't there. Maybe it was overinflated price. So keeping an eye out there should be multiple people in the approval process of bills. So you see what's getting paid. Also, you would, take a look at your bank statements so you can see the transactions that are going through there. And, similarly, I've seen people that had an on-site person who was doing their own payroll, cut themselves extra bonus checks, or had a debit card and was using the debit card for personal expenses. You just have to pay attention, because this is another place where you have that leaky, you have a leak in your bucket, so to speak, and money's dropping out of the bottom. You shouldn't have these issues. So by looking at having some internal controls where two people are reviewing bills before they're paid, that you're looking at bank statements, that you can see transactions and go line by line, and that somebody is reviewing debit card or credit card charges besides just one person. And so it's split up. And then you're also going to see, like in these financial reports, that they're correct. And the one way to know that they're correct is also getting a bank reconciliation report that proves what's on the financial reports matches up with what's on the bank statements. So just a couple of ways, because that's a terrible way to be, not be able to, you have to pass along increased costs because somebody stole money, and now you've got to get the money back by increasing costs on the rest of the owners. And I have seen this, even recently last year. And so it's something to be cognizant about.
Yeah. Well, I think as we summarize today, it's expensive to own real estate. We know that. You want to be intentional about what you're doing as a board member and as a board. You don't want to be allowing leaking money, whether it's fraud or leaky water or other things that are making mistakes. Confirm where the dollars are going. Make sure that it's not going to the wrong places where you're not getting value. If the pool service company is supposed to come twice a week, make sure they're coming twice a week. Just little simple things like that.
Yeah. One other thing, if the pool company was supposed to include chemicals, make sure they're not charging you extra for chemicals. We had all these extra add-on charges. Make sure that you go through them. And I would say, while people are going through their budgets, go through every expense. The last board may have had different expenses than this board wants to have. Just like if you reviewed all of your checkbook and you saw, oh yeah, I was paying these subscriptions for these 3 services that I no longer use, and you go and cancel them. Do the same thing at your community.
I like that. Well, Russell, you're a wealth of information. It's great talking with you and having you on the program, sharing some of your insights, the things that you've seen, the experiences that you've gained over the years. Any final closing thoughts to add at this time?
I'd say that pricing pressure is real for boards on fixed budgets. Boards need to take action on the items that we discussed today to reduce that pressure from being transferred to the homeowners through charge increases. So take your notes from this episode and have a discussion at your next board meeting and see which of these steps you can take to make a difference this year at your community.
I like that. Speaking about that, you did have a list, and are you okay with me having that list posted in the show notes as
Absolutely.
a reminder? Okay, cool. We hope there's a lot of value. We want you to have value. We want your association to succeed. If you'd like to get in touch with Russell and see what Community Financials can do to support your association, you can see more at, it's very simple, communityfinancials.com. And we hope you learned some great HOA insights from our discussion today that helps you bring common sense to your common areas. And in today's theme, a reduction in costs, or at least containing those costs. We look forward to having you join us for another great episode next week.
You've been listening to HOA Insights, Common Sense for Common Areas. You can listen to the show on our podcast website, hoainsights.org, or subscribe on any of the most popular podcast platforms. You can also watch the show on our YouTube channel. Check the show notes for helpful links. If you like the show and want to support the work we do, you can do so in a number of ways. The most important thing you can do is engage in the conversation. Leave a question in the comments section on our YouTube video. You can also email your questions or voice memos to podcast@hoainsights.org or leave us a voicemail at 805-203-3130. If you gain any insights from the show, please do us a huge favor by sharing the show with other board members you know. You can also support us by supporting the brands that sponsor this program. Please remember that the views and opinions expressed by the podcast do not constitute legal advice. You'll want to consult your own legal counsel before making any important decisions. Finally, this podcast was expertly mixed and mastered by Stokelight Video and Marketing. With Stokelight on your team, you'll reach more customers with marketing expertise that inspires action. See the show notes to connect with Stokelight.